Hello, everyone, and happy Thanksgiving. Um, and I don't know if we're going to have a lot of our American friends today, because today I believe a lot of our American friends are going to be right about the time they're preparing the turkey. So, hello, everyone from the rest of the world. Maybe there'll be someone from America, I don't know, but if not, they can see this on the time delay. But again, to anyone watching, hope everyone has a very, very happy Thanksgiving. So, I'm just going to jump into week 9, which is regulation. I always find this very sad that this tends to have the fewest number of participants of any session, and this has been true for the last 7 years and the last 14 times we've done this. But I think this is really fun. I think this is very important. I think these are practical things one needs to know in order to actually be successful in this space, because a successful idea that runs into regulatory problems might not in the end be a successful idea. And so these are topics that you have to be able to work through. And the goal isn't, well, certainly not from this session, but even if you took the whole program here at UNIC, the goal is not to become a lawyer. The goal is to know when you should call a lawyer, right? That is a very good outcome to say, I'm doing something in the space, maybe I should call a lawyer. And when I'm doing this particular thing, because this is the type of thing, the class of thing that might require a lawyer's assistance. And the reason I say this is fun, because all of this does sound like not a lot of fun. Like people, if you tell someone, is it fun to have a lawyer and to have to talk to a lawyer about a variety of things, the general thing they will say is, no, that's not fun at all. The reason I'm saying this part is fun is because it allows you to think intellectually and structurally and conceptually about what cryptocurrency is. Because we have a variety of laws for a variety of reasons in countries. These laws regulate securities, they regulate money, they regulate banks, they regulate money transmitters, they regulate investment managers, they regulate mutual funds, they regulate real estate investment trusts, they regulate commodities, they regulate financial instruments, they regulate a whole set of many and very interesting things. And then there becomes this interesting question of Bitcoin emerged, then Ethereum, then thousands of others, crypto assets. And the interesting question becomes, what are these things and how should they be regulated? And, this is the part in the discussion. So, some crypto native people say, no, we're not going to be regulated. We shouldn't be regulated. And I am as crypto native as they get. I am as deeply interested in decentralization as they get. I have been involved in Bitcoin since summer of 2013. I believe regulation, A, is inevitable, B, anyway exists. Right? It's not like there's a question of whether it exists or not exists. It does exist. And the point isn't to believe that somehow, through some strange reason, crypto will be the only thing in society to which laws and the state and society have no application to. The whole point is to work to make sure it is sensible. It does not hit upon the core features of crypto assets, which in my opinion tend to be the open innovation, the permissionlessness, the globalization. Right? These are important topics. They're very valuable topics. They will drive innovation and from there human welfare. And how one can navigate the inevitable regulation and end up in a successful outcome. They say, no, you're being a boomer, this is too not radical enough. And one of the benefits of having been through a second and third and fourth cycle, including the original cycle of the internet's adoption, where the founder of the electronic freedom frontier, it's very interesting, he made a declaration of the independence of cyberspace. Sounds very much how we talk about things in crypto, that we're not going to be tied by your laws, and we're going to do our own things, and you guys can stick with the physical world, but here in the virtual world, we're going to do our own thing. And that turns out just not to be true. It does not to be an accurate framing of how reality works. And the reason is, cyberspace isn't somewhere else. Right? Who are the participants in the internet, in cyberspace, in crypto, in the metaverse? What physically, literally is participating? Well, it's human beings, number one. And those human beings live in meat space. They're specific individuals who live in specific countries, specific cities, specific states and provinces, and are deeply, very much in meat space, which means, and I don't want to be over dramatic, but I think this is accurate, it means someone can come arrest them. At the end of the day, this is what, at the end of the line of regulation of laws, it all ends with, can someone come arrest you? And in 2021, the answer for all of us is yes. None of us have become dematerialized quantum entities. We are in physical bodies. We're in some jurisdiction. If that jurisdiction has unsensible rules, and then you violate them, and then you get caught, they can arrest you. And that's generally considered undesirable. And people generally try to avoid that. And because people generally try to avoid that, like that's why most of the time regulations end up getting followed, right? So that's one problem. Well, I'm not even sure it's a problem, it's one thing. The second set of participants in cyberspace, you talk about the cloud or the Ethereum network or so on. And it sounds very ethereal, like it's not real, like it's someplace you can't get to. None of that's true either. All these things are servers. And what are servers? They're computers. And are computers physical material? Yeah, they're physical material. They are an actual box that is plugged into an actual wall, that is connecting through an actual internet service provider, that is also confiscatable. As we stand today in 2021, we are living in the material world, right? Like Madonna. We're living in the physical world. Our computers are in the physical world. Our bodies are in the physical world. For better or for worse, regardless of what we might think, the large, overwhelming percentage of human society, whether they live in democracy, whether they vote for republics, most likely, or whether they live in more top-down systems, which is even worse, lives in places where people believe rules should apply to other people. Most people believe it, right? And if you go and ask most people if they believe that rules should not apply to crypto, pretty much everyone's going to say that doesn't sound like a very sensible idea, right? Like in top-down dictatorially oriented systems, or in that direction, authoritarian systems, they definitely don't believe that, right? The guys on top definitely don't believe that. You tell them, oh, great, this is great, it's going to decentralize power. That does not sound like a desirable outcome to an authoritarian regime. But even if you go to a democratic regime and, take a vote and say, like, yeah, let's take a very simple vote. Should gains in crypto be taxed? Well, okay, that's kind of interesting, right? Like, let's survey the whole population and say, should your labor income be taxed? And your gains from selling your house be taxed? And should your gains from selling a piece of art be taxed? And should your gains from selling a company be taxed? But hey, if the crypto guys sell their crypto for a higher price than they bought it before, should it not be taxed? I can tell you what the vote's going to come out like, right? No one's going to say, oh yeah, no, I want all my stuff to be taxed, but none of their stuff to be taxed, right? No one's going to think that way. Now, you might be in favor of lower taxes in general, or fewer taxes, or not taxes on capital gains. That's great, right? Or maybe targeted incentives. That's also great. But as a general rule, the practical outcome is that we end up being in some regulatory regime. And now, having been around the block through at least 4 cycles of crypto, even in any specific cycle, people start off with, oh, yeah, no, this stuff doesn't apply to me. And then by the end of the cycle, they discover that it does apply to them, right? It happened with money transmitters in the early days of exchanges, where people were operating exchanges and were not applying the normal money transmitter bank secrecy type laws. And I feel sympathetic to those people because a year earlier, this stuff had basically zero value, and it was like trading, I don't know, imaginary funny money, monopoly money, like it was silly stuff. Why would you imagine you needed the compliance department of a bank? And then the US was kind of rough with people like Charlie Shrem, where, sure, technically he might have violated some anti-money laundering statutes, but the big banks violate those all the time. And generally when the big banks violate them, they pay a fine and move on and nobody goes to jail. But for some reason, like the only person I remember going to jail from kind of a financial institution is the guy who was running a crypto exchange. And this is because life's a little bit unfair, and because this is the system saying, you know, this is the system saying, you know, we have power over this too, right? We have power over this too. We're making a point. You have to listen to us. And then the same thing happened with ICOs, right? Like, oh, and ICOs, in a way, were like 3 different things. An unbelievable way to raise capital globally, not through intermediaries, directly from consumers around the world. It was incredible. And then the second piece was a bunch of scammy ICOs, some of which didn't even realize they were being scammy. Right? I think some of them were just naive, and some of them were openly scammy. And then the third lens on ICOs is a lot of them were securities violations, and we discovered that later. And eventually the regulators got around to chasing people around. And so I believe this stuff is going to happen. I believe there's going to be regulation. I believe there is regulation. And I am practical. I want things. I believe decentralized systems are good for the world. I believe most of them can be made to operate compliantly. Not all of them, but most of them. I believe I want more of these systems to operate in the world. And I believe the fastest way for these systems not to operate in the world is for the people running them to get in trouble, get fined, go to jail, what happens. So, if at all possible, and this is true for the majority of systems, if at all possible, I'd like people to think through these issues, find a way to structure their idea in a way that is not going to run into problems with these issues so they can be successful. I want people to be successful. And I've gone through this, I've seen this happen to a bunch of people or a bunch of teams over the years where, you know, the system got them effectively. And it's not that like I believe more in the system or someone believes less or what have you. The system's a system. The question is, how are you practically going to operate when that system exists, right? Like, if you believe the taxation regime in the United States should change, strictly speaking, the correct thing to do is to elect representatives who share your belief who will change the laws. If you don't change the laws and just decide not to pay your taxes, I mean, you might get away with it, and that's fine. But you might not get away with it and get in trouble. And I don't know. I mean, to me, this is endless aggravation when instead you have in front of you, we all have in front of us, one of the greatest opportunities for innovation in generations. And it frustrates me sometimes that people think like, oh, well, the exciting thing is like, oh, maybe we're not going to pay taxes. Or who cares? Like, why? Without getting the question about, is the tax rate right? Is it wrong? Is it used for the correct purposes? Why is that the important thing? The important thing here is we can build interesting new systems, interesting new innovative systems. And I'd love people to like not get themselves in trouble while they're doing that, because it makes it less likely they'll build, successful, interesting new systems. Now, there might be some edge cases where compromise is not possible. And I don't know how I feel about this, right? Like if you want to be running an anonymous Bitcoin mixer, there is probably an unsolvable problem between you and the state. I think the state is not going to ever be cool with it. The flip side is if you try and make it compliant, it no longer does what you want it to do. So there's a set of services, products, etc., where there's a fundamental incompatibility. But that's not most things. Most things, you can still do what you need to do and make a couple calls to your lawyer and tax accountant and do things in a way that you can sleep easy at night on that topic and focus on actually doing the important thing, which is building a new, exciting, innovative system. So, with that monologue at the beginning, let me go to a couple questions. And then if I get through the questions, I'll talk about what I believe are the more interesting things that aren't in the questions. Number one, I have a few questions on the aspect of receiving Bitcoin as payment for work. To clarify, in the USA, if Bitcoin is received as income, then when it is transacted, there are no capital gain taxes. Would this be the case if it was exchanged for fiat? Secondly, I see more people opting to have their pay as Bitcoin. With the limited supply that is clearly not sustainable, do you see a future of payment in Bitcoin or another cryptocurrency? Thank you. All right, so this looks like a simple question. There's like 10 different topics in here, and we're going to unpack them all. First of all, I should say, I'm not a tax accountant. I'm not a tax lawyer. I'm not your tax accountant. I'm not your tax lawyer. Your jurisdiction might be different. The laws might change. I'm speaking generally, right? So I think I know the answer to this question, but don't take this as verbatim tax advice. You should still have a qualified professional give you tax advice, not me, right? So let's take this case. You've received income in Bitcoin, and then you sold it. In the US, what's the tax treatment for this? So let's make the example even more specific. I'm working for a company. My company is very open-minded, progressive, etc. I say I would like to receive my salary in Bitcoin. I was making $5,000 a month before. I'm still getting $5,000 a month, except my salary is now being transacted in Bitcoin, right? Because that's the normal case. The normal case is not that someone is going to say, cool, I'm going to have my salary denominated in Bitcoin, using Bitcoin as a unit of account. The normal case is the salary still stays denominated in fiat, $5,000 a month, right? And by the way, this is where the volatility is an issue for it being a unit of account, right? Because most people can't manage their lives if one day their salary is like $5,000 and the next day their salary is $1,500, the next day it's $8,000, right? So it ends up being denominated in usually in fiat. So end of the month comes, company's going to pay me $5,000 of salary. They convert it to Bitcoin. That's 0.08 whatever Bitcoin today. And instead of me getting an ACH transfer of $5,000 in my bank account, I get a Bitcoin transfer of 0.08 BTC. What's the tax treatment? Oh, this is salary income. This is ordinary income, exactly in the same way that if you had received dollars, which arguably is sensible. If I'm going to work and doing a certain job, and I get a salary for doing that certain job, and if it was taxable in dollars, but not taxable in Bitcoin, seems weird, right? And then the next day, everyone's like, woohoo, we're going to now pay everyone in Bitcoin. We don't have to pay taxes. I mean, that's cool if you're the first person who does it. When all 180 million people working in the United States do it, then realistically, some other tax is going to go up or what have you, right? I mean, it's not, the people have not yet decided that they don't want the services of the federal government, for better or for worse. So, the same thing would apply, by the way, if the company decided to pay you in euros or yen or gold or anything else. So if you have gross income of $5,000, you have taxes on $5,000, then you have income tax, you have payroll taxes, the company has payroll taxes, you have some unemployment taxes, etc. There's all these taxes. The taxes apply in exactly the same way. And at the end, on a post-tax basis, you have whatever, 0.06 BTC. At the time you've received it, let's make our math easy. Let's say at the time you received it, you received 0.1 BTC, and BTC was $50,000 in that day. You received it, you had your income, you have your income taxes due. Now you have an asset that the day you got it was worth $5,000. That is your cost basis. Let's say you don't spend it. You're a hodler. You've got that 0.1 BTC. And you just wait, hold it. And it's a year from now, and happy times, Bitcoin is now worth $100,000. Your 0.1 BTC is worth $10,000. Are any taxes due? No, nothing. You have an unrealized capital gain that is not taxable. Cool. You wait another year. Now Bitcoin is worth, let's really enjoy ourselves, $1 million. This is not investment advice. I don't think Bitcoin is going to be worth $1 million in 2 years. But since we're having fun with round numbers, let's say it was. Okay, your 0.1 Bitcoin is worth $100,000. You now want to buy a new car. You sell it for dollars. You get $100,000. It's a pretty nice car, but yeah. Bitcoin's $1 million. Bitcoin's $1 million. Everyone gets nice cars. You have a capital gains of $95,000. So, why? Because you got $100,000, but you had paid, in this case, you had paid with your labor, but you had paid $5,000 to get it. So the day you got the Bitcoin, it was $5,000. The day you sold it was $100,000. The difference is $95,000. That's your profit. But because it was a gain of capital, it wasn't labor income, it wasn't something you worked for, it gets taxed at the capital gains rate, which is lower than the ordinary income rate. A lot of people wonder if it's fair or not fair. How come people with capital get a lower tax rate than people with their labor? I don't know what's right or wrong in this, but what I can tell you is the reason I think it's this way is labor is more immobile and capital is more mobile. It's easier to invest your capital somewhere else where it has a lower tax rate than it is to move yourself and work somewhere else with a lower tax rate. So I think for this reason, the taxes on capital tend to be lower than the taxes on labor. That's my theory. Others may disagree. So that's the tax treatment, but there's more to this question. It says, more people pay in Bitcoin with a limited supply. This is not sustainable. Well, I don't think that's right either. So theoretically, if there's a lot of demand for Bitcoin, there will be more buyers of Bitcoin. If everything else is equal and there's more buyers of Bitcoin, what do we think will happen to the price? Well, the price should go up. That's normally how it works. If the price goes up, the market capitalization, the total value of all Bitcoins, also goes up. And because Bitcoins are divisible to the 8th degree, it means you're not going to run out of Bitcoin with which to pay people. What would happen in the world that like everyone wants to get paid in Bitcoin, so there's like endless demand to buy Bitcoin in order to pay people, the price of Bitcoin would go up, and the amount of Bitcoin you would need to pay someone $5,000 a month will be less Bitcoin. So there was a question in the chat, which is a good question, that says, it's going back to my capital gains example. And it says, all right, yeah, I sold the Bitcoin for $100,000. Then I use those dollars to buy my chic car. And that was taxable, and that doesn't sound very nice. Let's say I skipped that step of selling to fiat, and instead my step was I go directly and I buy the car for Bitcoin. Sadly, under the rules of the United States, you still owe taxes on the 95%. It is still a realization. You have realized the value of the increase of your Bitcoins, and you still have benefited. The fact that instead of getting $100,000 in cash, you got $100,000 of a car doesn't make any difference. And again, it makes sense that it doesn't make any difference, because if it made a difference, then people would start selling things for the asset that did not get taxed. And is there any kind of societally relevant reason that you want people to buy cars and Bitcoins or gold or fine art instead of dollars? Not really, right? I mean, it just makes the world more inefficient in substance to avoid tax. And good tax policy shouldn't do that. And so the reality is, it doesn't matter what you get paid in, you're going to, or what you buy with, you're going to pay taxes all the same. Now, all of this is very country specific. Like, for example, Brazil has, I think, a $5,000 exemption on capital gains in cryptocurrency. I think some countries, I think the United Arab Emirates, do not charge capital gains at all in cryptocurrency. So none of this is specific, is a general rule. Tax policy varies widely across the world. And a lot of countries try to compete on tax policy in order to attract businesses, or sometimes individuals, to come live in their country so that they have greater economic development. And this is the trade-off countries are doing, right? Because countries are also in competition with each other, right? And they want to generate more wealth for their country and the people in their country. And say, like, well, maybe if I have lower taxes, sure, I'll collect less money from these companies or people or have you, but maybe more people will come here, and maybe my smaller percentage of a larger pie is bigger than my larger percentage of a smaller pie. And taken to the extreme, some countries like don't charge tax at all and say, like, well, I'm not getting any tax, but the people who live here, in order to not pay the tax, go to restaurants and buy houses and go to movie theaters. And so they're stimulating the economy that way. There's no right or wrong answer on this. On the extremes, there's probably some wrong answers, right? If you taxed everyone at 99% of their income, the incentive to work would be quite low. So, but within the kind of where most modern societies have ended up, I don't think there's particularly righter or wronger answers. There are trade-offs, and there's this constant rebalancing of these trade-offs in a competitive environment, because countries are competing with each other to try and find what's the best way to encourage more economic development while still collecting taxes, right? That's what they're all trying to do. Okay. Ooh. Huh. I have a very specific question, which I don't think I can answer. If a person based out of Canada purchases digital asset in exchange in Canada in Canadian dollars, transfers to his own wallet in India, and sells them in exchange in India in Indian rupees, how does the taxation apply or work in that scenario? This one really needs another part, asking for a friend. It sounds extremely specific. Honestly, I have no idea. I don't know the specific laws of Canada. I don't know the specific laws of India. We don't know if this individual is Canadian or Indian. We don't know if they're tax residents in Canada or India. And without knowing all these things and being a specialist in these matters, you don't know. And this is a good example. The reason I read it, it's a good example of why this stuff's complicated, and it is individual and situation specific. And so this is the perfect type of question to ask one's tax accountant, right? Next question. I realize there was only one slide in this week's class regarding energy use, but I'm curious if you've heard about any studies that have been done that estimate how much energy is required to maintain our global centralized banking system on a yearly basis. There is a lot of news about the energy required to run the BTC network, but I think it will be useful to compare our central bank's energy usage to compare. Central banks and their affiliate banks also use energy to maintain their servers, computers, buildings, condition their buildings for their employees, light, air conditioning, heating. I can guess it's no small amount of energy, but it's good to compare. And this is in the context of the slide that talks about Sweden considers banning proof of work. Proof of work is the way Bitcoin does security. It's the way Ethereum still does security, though Ethereum has stated they're going to switch to proof of stake. There is an interesting debate among the proof of work team and the proof of stake team about which one is more decentralized. But it is fair to say that there is significant pressure by governments against proof of work type mining. Theoretically, I'm not 100% sure I believe it, but theoretically, because of environmental reasons. The question is very interesting that was asked. This question that was asked is, well, okay, we know it uses energy, right? Right, everyone knows that. But how does this match with other things that use energy? Because other things that use energy are the existing system too. Right? They use energy too. So what's the difference? And that's a very good question, and I have not seen good analyses. Because the analysis of how much energy the system needs to run, the existing system, is actually quite a lot. You shouldn't think of it as the banks only, or the central banks only. You're running a whole financial system which has millions and tens of millions of employees. And we're not talking about just the air conditioning at their offices. You should be thinking about the carbon footprint of every single employee there. You should be thinking about the carbon footprint of their data centers, of their cybersecurity teams, because a lot of the carbon footprint of cryptocurrency is replicated with humans in the existing system. And humans don't just emit carbon when they come to work. They emit carbon when they're doing anything else. And so I believe a fair assessment, and you should do it on both sides, right? Humans are also required to run Bitcoin mining farms and design Bitcoin chips and mining chips. So you should account for this on both sides. But there's no doubt that the existing system uses a lot more humans to establish consensus and trust than the cryptocurrency system. And then there's no question, how far do you extend it? Well, some of these things are resolved in courts of law. And some Bitcoin things might get resolved in courts of law, but more things in the existing system. So how much of the judicial system should you put into place? How about law enforcement? How about physical security? Police, armies, right? Central banks still hold gold, right? Like literal bars of gold. Like in some silly action movie, someone could come steal them. And part of the reason someone doesn't like descend on Fort Knox to steal the gold bars from the United States of America is the United States of America is a fairly advanced security state. Take the whole thing from local law enforcement over way to the military, and that security state is quite capable of defending Fort Knox. Well, that stuff costs a lot of money too, right? That stuff generates a lot of carbon too. And so I think this is the right question. I think there should be both proof of work and proof of stake systems. So I agree with that. I think the proof of stake systems are good. Everyone agrees there should be proof of stake systems. I believe it would be good if we keep a proof of work system running as well, even though there's going to be significant temptation by certain countries for environmental reasons or for environmental reasons to try and ban mining, proof of work type mining. But in order to have an intelligent discussion about this, there would really need to be thoughtful analysis on both sides. And there isn't. Part of the reason we only talk about the carbon footprint of cryptocurrencies is because it's easy to calculate. The carbon footprint of running the off-chain system of trust is very complicated to calculate, and so I'm going to do this. It's hard to see. It's hard. Why do you look for your keys? It's the drunk man looking for his keys at night, right? Why are you looking for your keys under the streetlight? Did you leave them there? No, I didn't leave them there. Well, why are you looking for them there? Well, that's where the light is, right? And so it's fairly trivial to calculate the carbon footprint of a public cryptocurrency network. it is both definitionally and practically difficult to calculate the carbon footprint of the off-chain system of trust. Because the off-chain system of trust is a lot of different entities playing a lot of different roles to make things viable. There's also another question of, if you believe this is an issue, should you ban it, or should you just carbon tax it? It's anyway going to end up in renewables because they're cheaper. Right? One of the nice things about Bitcoin mining is it's not that affected by latency. It's a little bit of an effect, but not a big latency, not a big effect. So it will end up where the cheapest energy is, and the cheapest energy is stranded energy. Like if you have a bunch of geothermal energy in Iceland, which exists, that's 100% renewable, which it is. Today, it's 100% wasted. I mean, not 100%, used to heat Reykjavik. But there's much more geothermal energy in Iceland than is needed to heat Reykjavik. And because Reykjavik is approximately in the middle of nowhere, right? It's the middle of the Atlantic. There's no particularly cost-effective way to use that energy to power homes in London. But could you use that energy to power Bitcoin miners and provide security to the system? And provide security to the system without generating a carbon footprint? Yes. And so, if you see some value in having a proof-of-work system, which I do, if you worry about carbon output, which I think is important to worry about, I don't think it's a non-important topic, then I do think the two things you need to think about are, how does it compare to the alternatives, and is it better or worse? And can you push it to renewable sources, which is anyway going to head that direction, but maybe it gives incentives to push to renewable sources, as opposed to saying, oh, I'm just going to blanket ban it. The people who want to ban it basically see limited value in it, I think. They say, oh, well, this doesn't add anything anyway, and it has this big negative, which consumes energy. And so you don't have this balanced discussion of like, well, what are the risks? What are the rewards of, what are the costs and benefits of running proof-of-work mining? And if they only see bad things about running it, then there's an issue. So, let's go to the next question. Countries like Portugal, UAE, and Singapore have been making laws and regulations that are not just crypto-friendly, but it's a long question, but they are trying to track international talent and crypto companies by simple, readable laws, low to zero taxation for individuals holding crypto, and low to zero free zone tax for companies. At the same time, China is banning crypto, and the US is becoming highly unpopular to the crypto community as politicians who have no clue on what crypto is are making rules, making statements, taking decisions like the unrealized capital gains rules to proposed law, or the hidden paragraphs behind the infrastructure bill that initially tried to characterize every crypto entity as a agent, as a money transmitter. It seems like a volatile environment where each country is choosing their side, and at the same time, people and countries are choosing countries. Which side should Cyprus and Greece choose, in your opinion? Oh, this is a very specific question. Are there larger economic entities that would not allow this to happen? Furthermore, should the EU adopt an overall approach, and if it should, can individual countries, for example, like Portugal and Germany, with different approaches, reach consensus? I'm a believer in crypto assets and blockchains. I believe countries should be generally supportive. I believe, to answer a specific question, Cyprus and Greece should be generally supportive. I believe for a country to gain competitive advantage with this, they have to be faster rather than slower. Cyprus is passing now a framework legislation for blockchain, probably in 2022, but wasn't so fast about it. Greece hasn't even gotten out of the gates, as far as I can tell, on this topic. So it's a tough topic. Countries are afraid. The EU tends to be conservative. The EU is going to try and impose some common cross-EU standards. The EU does not like this idea of one country trying to compete with the other on these topics. Right? They'd rather have common standards. I think how much a country can escape or not escape depends on what the country is. Right? Germany has more power in setting the rules to be oriented towards what they want to do than Portugal or Greece or Cyprus do. Right? The bigger countries do effectively have more of a say in the EU than the smaller countries. I think the EU is broadly missing the boat on the opportunity the EU has with crypto, which is the following. The EU is very far behind in Web 2. All the big Web 2 companies are American. Google, Microsoft, Amazon, Facebook, Twitter, Netflix, all American. There's no comparable big Web 2 European tech company. I believe still the largest tech company by market size in the EU is SAP. SAP is in Web 2. It's like not even Web 1. It's like pre-Web. Right? And the EU gets very concerned about this, and they have panels to think about their international competitiveness and what they can do about it. And then they come up with ideas that more or less make the problem worse, right? Like the classes of ideas they sometimes come up with is like, well, let's regulate them more. And it turns out Facebook can pay for enough lawyers to comply with whatever rules the EU can come up with, but maybe smaller startups can't. So the opportunity that the EU is missing is that the way to eat up the Web 2 giants is by 1,000 small Web 3 companies, where they can create shared economic incentives for the users among themselves and the providers, where you can blend the company and its users, right? They can be one thing. And they have not done that. I have hoped for a while that they would do that, and they have not done that. It is a failure of imagination, in my opinion, and it is a significant failure of imagination. It's a shame. I believe that despite the fact that the US has been not hugely friendly to crypto relative to what it could have been, despite that, I suspect in the end, the US will be more friendly than the EU to crypto. It's bizarre, but I think that's going to be the case. And what's going to happen then is, if that happens, the US will end up winning Web3 as well. And then when the US wins Web3 in a decade, the EU will be having discussions about why it doesn't have a Web3 industry and blah, 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 blah. It's because it's not been hugely supportive, right? And like, the EU doesn't see the opportunity, I don't think. And at the highest levels, it doesn't see the opportunity. It views crypto, it's very much a blockchain, not crypto. And blockchains are permission systems, and they're a useful form of IT. And it's very good that these permission systems exist. and they're nice incremental improvements on other forms of internal databases, but they're not going to drive mega innovation because they're permissioned. They are just like the old system. The part that could drive innovation are the open, permissionless systems. And if I were running the EU and if someone gave me the keys to the regulatory castle, which they will not because I'm too radical, but like if I were, I would be as welcoming as possible to Web3 type companies, most of which will be built on some type of crypto asset rails. And you could build a real tech powerhouse for the next evolution of the internet. But I don't think they're there. I don't think they've grasped it. I don't think they've grasped the opportunity. And some of the smaller countries are trying, but like for it to really happen, it's not going to happen from the Portugals or the Cypruses or the Maltas. That'll happen on the margin. Like if the EU was really going to make it, it would have to happen at the level of the big companies, of the community, of everyone actually going for it. Let's see. The Federal Reserve of the U.S. is already thinking about the CBDC version of the dollar. Yes, they are. How much do you think it'll change the blockchain ecosystem in terms of adoption from a regulatory perspective? Do you think KYC will still be required? How is this going to be related with the CCPA, Consumer California Privacy Act? The Consumer California Privacy Act is the Californian version of GDPR. It's the only state in the United States that has adopted something like this. The GDPR is a European legislation that focuses on privacy for how companies process your data. It's well-intentioned, I think. I think it's much less effective than it could have been. It's one of those typical European things. It's well-intentioned, but does not have the same effects one might have hoped to have the same effects. The effects that one might have hoped to have. Do I believe this will get rid of KYC? No, absolutely not. This will increase the use of KYC. KYC is going nowhere. The governments are very interested in KYC. I believe the CBDC dollar, when it exists, will be KYC'd. There's no chance they're going to say the CBDC dollar is KYC'd, but, Ethereum or Tether shouldn't be. They're going to push that for both of those. How is it going to interact with the CCPA? I have no idea. That's a very good question. It's kind of non-obvious to me how any cryptocurrency, truly public cryptocurrency, truly decentralized public cryptocurrency interacts with GDPR and so on. I think these are just basically incompatible concepts. GDPR needs to be adapted a little bit to take this into account, right? Because, GDPR says, you have to have the right to delete your data from a company that has it. That's fine. It's very sensible. There's no counterparty on the Bitcoin blockchain who can say, I would like you to delete your data from block 7,000 blocks ago. There's no one there to do it. There's no one to be forced to do it. There's no one that can make it happen. And so, practically speaking, these types of provisions don't apply. And it would be better if GDPR and whatever next iteration just explicitly recognizes this and tries to separate out permissioned and non-permissioned systems, right? Like these things could apply in permission systems, but they might not apply in non-permissioned systems. Yeah, I see a couple of questions. Let me try and answer a couple of them from the chat. All these examples are the case if Bitcoin's considered an asset. What if it's recognized as a currency? In the United States, it's treated as an asset, right? That's the examples I'm using. It's treated as an asset. Why do I use the United States? It's the kind of only big regulatory zone that's crystal clear what they're doing. Europe has different treatments in different countries. So I can't give a general answer about Europe. Then there's a comment about the question of divisibility. They say, but if many big holders are not bringing BTC into circulation, won't it cause a temporary pseudo-inflation situation? I think inflation is the right word here, right? Inflation is when the value of money drops. It means goods and services priced in your unit of account are going up. You could previously buy a TV for $1,000. Now it's $2,000. Okay. That's inflation. What you mean is the price of Bitcoin is going to go up. And that's not inflation, right? So the price has gone up, and that's fine. I agree with this. That's what's going to happen. I agree if not a lot of people are selling Bitcoin and more people want to buy Bitcoin, the price of Bitcoin is going to go up. And so you will need fewer Bitcoins to pay any specific number of salaries. And the more the price goes up, the more there's demand, the more the price goes up, the fewer Bitcoins you'll need to pay any given amount of the fiat pair of Bitcoin to fiat. So this, of all the things I worry about, this I actually don't worry about at all. I think this part's fine. Tough question here. Would adding or withdrawing liquidity to from a liquidity pool be taxable? Technically, you're exchanging assets. This is an excellent tax question. Excellent, excellent, excellent tax question. Also, does wrapping Ether or wrapping Bitcoin, is that a taxable event? There's no definitive answer on these questions in the United States. These are the types of sophisticated questions that are coming up in DeFi. The super conservative answer is that each one of these is an exchange of one asset to another and is a taxable event. I hope someone takes the position and then fights it through, or that the IRS is sensible, or that the other regulators are sensible, that wrapping an asset does not make a taxable event. So, for example, if we have Ether and you turn it into wrapped Ether, you wrap it in an ERC20 token. Wrapped Ether trades almost exactly like Ether. You haven't effectively sold. But I think there's an open question how the IRS is going to treat it. They should not treat it as a taxable event, but in a very kind of strict reading of the law, maybe it could be. Same thing with staking assets into a liquidity pool, and then taking them back out, and like they haven't been sold, right? They just go in and out. Should not be a taxable event. Because in practice, you have not realized anything. But you get a different token to claim back your assets, and so you had one token, now you've got a different token. Could someone with a very strict interpretation treat it as a taxable event? Yes. Is this going to vary by country? Yes. Does any country have a clear policy position on this? No. No, these are things that are happening just now, on the margin, very cutting edge. We don't have clear answers to these questions yet. So with that, I'm going to wrap up for today's session. I think this is my last session with you all. I think you're going back to George for the next session. So I want to wish you good luck on the rest of the course. I want to welcome you again permanently into the UNIC alumni family. I hope we see some of you on the master's program or the conference or other online courses. We'll be launching some new ones in the spring, including one in the metaverse. I want to wish those of you celebrating a happy Thanksgiving. Happy Thanksgiving. And I wish all of you well. Thank you so much for joining. I very much appreciate it.